Good morning and welcome to the AUGMENTUM FinTech PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO Tim Levine. Good morning to you.
Good morning and a very warm welcome to everyone that's joining this Investor Meet Company presentation live, and I'm delighted to present our interim results to the period ending 30th September 2024. I will spend the best part of 25-30 minutes just talking you through the results and just giving a little colour, and then you'll see a Q&A tab where you're able to submit Q&A questions, and I will try and get through as many of those as I can in the time period. But without further ado, let's kick off. And where are we in these interim results? Well, kind of 6 years in, we remain a touch under 300 million in terms of net asset value. That NAV per share has hovered in recent kind of periods around that mid 160s. We'll talk about the discount and the huge value opportunity we think is available. Really important to note from a cash reserves point of view, we remain well capitalized and there is no debt. So we have zero debt in the business. And again, really important for us to have that. Portfolio very well established now at 26. For those that have been following and as shareholders or simply as watchers, the ambition was really to build a portfolio of 25 to 30 assets. And we'll talk about the diversification both by subsector but also by maturity as well. IRR, long-term objective is to deliver 20%. That kind of fluctuates. I think what's really important as a track record established is to look at that realized IRR. So what are you actually delivering rather than on a NAV basis? And we'll look a little bit on that. Really strong underlying growth across the portfolio, and really pleasing to see not only that, but continued shift to profitability for those more established businesses where we've really kind of pushed a mantra over the last 2 years of it shouldn't be growth at all costs. We need to have that path to profitability, strong unit economics, and good deployment in the period. There's been some activity post-period end, which we'll talk through as well, alongside some really kind of strong exit metrics as well that not only have been exiting at a significant premium on average to the previously reported valuation, but also as you look at that IRR, really well above our long-term expected return of around 20%. So where are we today in terms of portfolio? And this is an ever-moving feast, but I think what you see now is a diversification across the fintech sector that's really looking from our point of view as the type of distribution that we would like to see. Now, of course, the segments in each of these sectors will ebb and flow as there are exits, as companies kind of grow or exit the portfolio, or as we add new opportunities. I think what was really important to us up front was to kind of build that established portfolio where we could have that early diversification, in particular kind of 4 or 5 years ago, making sure that on the business to consumer side, those early consumer propositions that we identified, 1 or 2 real winners in there. And I think we're starting to see those break through at real scale now. The likes of Tide, the likes of Zopa and iWalker and the like are really kind of coming through to really deliver some significant scale. Equally important for us, where we felt 3-4 years ago we were underweight, was on that kind of B2B infrastructure side. So whether it's on digital assets, whether it's in insurance, whether it's in banking as a service, that for us has been an area where we've really built out expertise alongside recent exposure in the capital market space as well. And so I think you're seeing now some of these segments really starting to become established and hopefully in some cases will really start to kind of expand as a percentage of our overall coverage. And I think interestingly, we've talked a lot about what's happening in the insurance sector over the past 4 or 5 years, and up until a year and a half ago, really didn't have any exposure. And that's despite looking at a significant number of businesses in that space. And I think our reluctance to step into the insurance space was one, we would argue InsurTech 1.0 saw a lot of capital enter the sector, but very little material exit. So questionable whether there has been a unicorn exit in Europe in InsurTech. And I think for us, we want to be right. We just don't want to be right too early. And, we're starting to see that shift. In particular, we saw that catalyst post-COVID as markets such as Lloyd's really had to embrace that wave of digitization that many, frankly, within the Lloyd's market were quite resistant to. That has started to see that shift, and you'll see the likes of Artificial, which was a recent investment in the last period, alongside Baobab, German-based cyber insurance platform that we think is doing something really quite differentiated in the market as well, start to kind of build a presence in our portfolio as well. I won't dwell on the detail here. This presentation will be available, if not already, for you to download, but just gives you a sense of how the portfolio has developed over recent years and the equivalent periods in terms of NAV as well. And you can see, as I talked about, it's been a largely flat period. With a small reduction overall. And I'll talk about where that fluctuation has come on the upside and the downside as well. But what about IRR? Why do we use it? Over the long term, this is a platform that we believe can deliver, an outlier return. So, why 20%? Well, our historic track record in our previous fund was 19%. We feel that if we deliver 20%, then, we will be a top decile performer in the venture world. And that's both in the private markets, which is predominantly where venture operates through more traditional GPLP structures. And so for us, over the first 6 years, what we've done is, of course, look at both the unrealized IRR, but as the portfolio has started to mature and as those exits have started to be delivered, really start to kind of build out what has been that exited internal rate of return. And I think for us, we're still confident that long term, and what does long term mean? We would say you can really test the measure of this portfolio and this fund after 10 years. So we're just over halfway through. But those exits, those 7 exits to date, have delivered an IRR of 38%. Clearly, we'd love to maintain that. We think that's overly ambitious. But if we can bring that long-term realized IRR and maintain that north of 20, then I think we'll very much be on a strong track and really outperforming our peers. And in terms of what's been happening in deployment, well, if you look at the last 6 years and the average deployment through the kind of the feast or famine, it's averaged at around 30 million of annualized capital. Now, the question I'm often asked is, are you capped out by that? What we're restricted at the moment is our available cash. One, we want to make sure we have sufficient cash in the portfolio to be able to support that portfolio going forward, as long as being alongside trying to be able to capitalize on some of the most compelling new opportunities as well. So that's really important to us as well. But from an execution point of view, we could do a multiple. So depending on the year, depending on the pipeline, depending on the market, anywhere between 50 and 100 million, we would say we could put to work. But we're not in the position in the current market of having, an overweight amount of cash. But it is important for us to make sure that we keep active, we keep supporting those companies in the portfolios, those that are really kind of growing nicely, those that are really on that path to profitability, even those that have already reached that, alongside backing the next generation of what we think are, exciting potential venture return outcomes. So 12.5 million in the period, a number of investments within the existing portfolio supporting continued growth, but also 2 new investments as well, one within the period and one post-period end. Actually, our first investment in the MENA region with a business that we've been tracking for some time, a team that had spun out of the very successful European expense management business, Pleo, and we can talk a little bit about that later on as well. And as you can see, a fair few follow-on investments into the portfolio in the period, but generally quite a busy period overall. 2 new investments, 2 exits as well, one in the reporting period and one just in the last couple of weeks as well. So plenty going on in the market, which is encouraging, and will give you a sense of what we see from a pipeline point of view over the next 6 months, as well as really kind of build what are our priorities for 2025, both within the portfolio, but of course what's coming down the pipe in terms of new opportunities as well. It's very hard to talk to investors or prospective investors in this market without tackling what is a pretty significant discount in the market. And I think for me, it's always important to highlight the value and offer and why we think it's such a compelling proposition. And when you really kind of strip it out and you take the NAV, you take the market cap, depending on any, on the day that you look at kind of 169 million in this case, take the cash out, and then you've got this implied portfolio value of around 134 million. When you look at the portfolio value, when you strip out the cash, you're trading at around a 50% discount. So what do investors kind of have to believe? Well, first of all, you look at those kind of core established assets, in particular those that are some of the more mature, and you look at our top 5 assets at any one time. And this is purely on value, not on stage or maturity, etc. And that represents about 54% of the fair value. NAV. And these are businesses still, going really nicely on average, north of 50%. Their forward revenue multiple, touch over 4.5 as well. And just these 5 cover, around 119% of the implied portfolio value. So you've got that 16% discount. And then when you bring in the top 10, and remember, you've got 26 assets in the portfolio, just the top 10 are trading on that 37% discount. And so you've got a tale of some very exciting emerging early stage businesses. You've got some established companies that, for one reason or another, haven't delivered what we would have expected to be a venture outcome, but there's still some real residual value in there. And we can talk about some of the companies that we have exited that have delivered a significant premium to our holding value. And I think the cynic might look at a portfolio of 26 and say, well, we're only interested in 2 or 3 assets, and the tail we're going to write down to 0. I think when you look at a portfolio such as ours, there is a lot of inherent strategic value in a number of our businesses, even in those that perhaps aren't going to deliver the venture return outcome that we had made that calculated bet many years ago. But we have strong conviction that not only are we going to return their underlying value, but also we can target a premium to that as well. And I think that really kind of played out very effectively in recent weeks, where we had a business called Full Circle, which was originally an investment we made with Dudil. It had gone on a what I would regard as a typical up and down venture journey. It was quite clear to us a couple of years ago that it wasn't going to deliver a venture outcome. It didn't make sense for us to be continuing to support the company with significant capital and time. So we stepped off the board. We helped restructure the business. We found a partner to merge the business with where we could get that real scale. And we did write down the value accordingly. Now, what we always felt with that business was that it had real strategic value. It had a strong underlying proposition, but it wasn't getting to that material scale where we could see it, generating tens of millions of recurring SaaS-style revenues. At the end of the day, that business really kind of turned itself around. It got to profitability. It got to scale. It wasn't growing hugely, but at the end of the day, there was still growth. And then we sold that to Encino, a US software business, for $130 million, and that kind of delivered around an 80% premium to our holding value as well, and still delivered a multiple of return for something that we had, put in our tail to, nurture to exit. So I think a really good example of a business that you wouldn't have been aware of was in the tail. I think the cynic would have said, that's a business that we should write down to 0, but still has returned, £6 million for us to then be able to reinvest. So I think that's an important feature of the underlying portfolio, where you can really see that there are a number of businesses that can really underpin that valuation, as well as those kind of high growth, very exciting opportunities that we think have a long way to go as well. But what about, what's next? And we're often asked, well, what are your internal models talking about? And, we thought, well, let's just shine a light on our top three, give a little bit of color as to what the methodology is. And so you can see here in Tide, Zopa and Volt, our top three within our model. What are the assumptions that we would have with those businesses over the next 2 years? Where do we think they can go in terms of kind of valuation expectations? You can see collectively about 124 million of value. That's a touch under the implied portfolio value. Our assumption would be, well, we halve the growth over the next 2 years, because these are businesses that have grown, tremendously quickly. But of course, as they get to more scale, growing, 80-90% year on year becomes more challenges. But, halving the growth we think is a reasonable assumption. Maintain the current market multiple. And if you look at our multiples, they remain significantly below the market, especially when you bring into account the discount, and then model those out 2 years. And you can see, you're seeing that value growth from our internal models to pretty much kind of double from where they are today. And again, you kind of come back to both the market cap of 170 or even the implied portfolio value of 134 and say, there is a lot of value, and there are 23 further assets in the portfolio as well. So any which measure you look at it, there is a portfolio that's still got strong underlying growth, despite the fact that we've been operating in the last 2 to 3 years of some pretty extraordinary, challenging macro headwinds, geopolitical challenges as well. Hasn't made it an easy market to operate in yet. There is still a lot of growth and a lot of future growth opportunity as well. And then when we look at that maturity of the portfolio, how is that balance working? And we've talked about it before, but it's really important from a portfolio construction point of view to keep a close eye on this. So what have we got? We've got 6 assets that we would define as late. Late would be established, high growth, largely profitable. If I eyeball those, there would be 1, 2, 3, 4. 4 would be profitable, 1 break even, 1 still on the path to break even. And that's representing kind of half of the NAV, including cash. But we would expect an exit anywhere between 1 to 3 years, or certainly opportunities to present themselves. But then you've got a further 20 assets where you would expect a handful of those to really start to break through over the next couple of years, to come into that kind of established late part of the portfolio where there's still growth, but they're on that path to profitability. They're generating tens, if not hundreds of millions of pounds of revenue, and have really kind of come through to scale. And, as I said, on the growth side, you can still see by each stage, these are businesses as a whole, by stage, still growing really nicely. And that's really, really important for us as well. So there's a lot of exciting stuff in the early stage. I think investors should have a healthy dose of cynicism, but at the same time recognize that we have spent huge amounts of time really filtering the noise to try and identify those exceptional teams that have, a reasonable shot of building something truly transformative in the financial services sector. And, there are a number of kind of what I would regard as early candidates really showing some quite compelling and exciting traction. And we hope they will start to kind of come through both to the mid and then to the late stage as well over the next couple of years. But investors rightly want to see kind of tangible outcomes. And that is why we need to make sure we've got some of these more mature assets in size, not necessarily maturing in growth, because we still want to see good, healthy, double-digit, 30% plus growth in these companies. And then when the right opportunity presents itself, really look at, can we deliver a compelling realization back to investors as well. I'm going to touch on AI perhaps in the questions. So I'm going to kind of jump out of this, and then we can talk a little bit about AI. Suffice to say, when you look at the underlying portfolio, a large number of our companies have been working with AI for many years. So we're not kind of swept up in the AI hype. Yes, we're incredibly exciting at some of the technologies that are being deployed. Yes, we have been working very closely with the portfolio companies to ensure that they're using next generation technology. But fundamentally, we have some very strong businesses that are being driven by next generation AI. They're using that as their competitive advantage. And so when you think about an investment in Augmentum, you also have a number of businesses that are underpinned by AI, and in some cases are very much kind of a pure play AI proposition. I can point to Interim, based in Switzerland, which is really building out that trading platform for FX and developing other other potential instruments as well over the kind of coming year or so. So that's something to kind of keep an eye on. What I'm conscious not to do is oversell the AI proposition, because I think you are in danger of being kind of swept up in the hype of over promising. But I spent the whole day yesterday in Tide's annual strategy day for the board, and we had a very significant part of that looking at the AI work that they're doing, in particular kind of on Gen AI, and it is incredibly exciting. It's already having a very positive impact across the business, but I think there's a lot more to come over the next couple of years. I'm going to touch a little bit on valuation and relative valuation as well, and multiples, which is really important because investors like myself, as a big investor in Augmentum, rightly frustrated at the share price performance. Now, most importantly for us as a management team is to really focus on the portfolio, making sure that there's good oversight, good governance, good active management with our portfolio teams, as well as trying to kind of identify that next generation of companies. But at the same time, you can't ignore that as the global fintech index has gone on a real charge since we last spoke, which has kind of mirrored very much the NASDAQ alongside the NASDAQ X, the Magnificent Seven. I just thought it would be useful to demonstrate what are those companies doing in that global fintech index, and over the period, and we're using since January 23, where you can see our index from 100 has dropped below. The fintech index has grown about 36% on average, those companies, and our companies, around north of 100. So around 3x the pace, but the market is not recognizing that strong underlying growth on average across the portfolio. And what's been a big focus for us alongside that top line growth is not top line growth at all costs. And I think we've been very conscious that we need to demonstrate that there are businesses that are growing well, but as they start to kind of get to that maturing growth stage, they need to demonstrate profitability. They need to demonstrate strong unit economics, and where possible, really shift to profitability. What we don't want to be doing is maximizing these businesses for profitability unless we feel that that capital can't be reinvested in sustainable growth. And I think when we look across the portfolio, those businesses that are profitable, a lot of that profit is now being reinvested back in growth. And I think Tide's a great example where they're having some fantastic growth opportunities in international markets, India, Germany, other European markets likely to launch in the coming year as well. And it absolutely makes sense to continue to double down in a sustainable way there as well. Whereas in other cases, investors want to look for profitability. Perhaps a business might be looking on the IPO path, the likes of Zopa or Arwaka, that have been around for a while, growing very nicely. But the market is looking at, say, how profitable can these businesses become alongside maintaining a healthy growth rate. So you don't necessarily need to grow at 100%, but we'd love to see 30-40% growth as well as equivalent, if not greater, profit growth over that period. And I think there's been a lot of progress there that hasn't been reflected in our share price. And I think there is a disconnect between what we would regard as the private market now and the public markets. And I will touch on that in a little bit as well. But just in terms of how has the portfolio kind of ebbed and flowed and fluctuated, good kind of tick ups in a number of companies, just small. But I think the big kind of delta on the downside was Grover. And again, we can talk about that in the Q&A. Fundamentally, this is a business that has gone on a significant growth trajectory over the last 4 to 5 years. I think the challenge that we put to the company 18 months ago was we want to see better unit economics. We want to see a less cash consumptive business, a path to profitability. And, they've gone on that journey. There's been some, internal changes. We've brought our COO, Richard Matthews, onto the board there. And, there is a lot more scrutiny to make sure that has the right set of metrics that we think will allow it to deliver its full potential when it comes to exit. And as such, at this moment in time, we have taken a significant haircut because we believe that best reflects, where the market is at the moment. And, we're hopeful that the business over the next 6 months can really kind of recalibrate, get to profitability, and then hopefully, the rewards will be there down the line. But I think it's important always to recognize that, we are in the business of taking early bets. Some of those bets will come off in time and hopefully at a very significant multiple, and some won't. And as some of these businesses go on their journey, even the most successful ones, they do have blips along the way. And I think Zopa and Iwaka are two great examples of businesses that are performing exceptionally well now. But 3 years ago, in particular, in Iwaka's case and in Zopa's case, COVID was unbelievably challenging. And I would say in Iwaka's case was existential. And I think it's huge credit to that management team that they saw a way to get through COVID, a very difficult 18 to 24 months. And we wrote that down to the liquidation preference in effect. So i.e., the business needed to sell for a 90% discount to its last round. And now as the business becomes, very profitable, still significant growth, north of 250 million of revenue, it's really kind of demonstrated it's not only its resilience, but its ability to kind of navigate through some challenging times and then capitalize on that. So there will be kind of ups and downs across the portfolio over time. And as I said, over the long term, you'll really be able to kind of demonstrate the capability, of us as a team in terms of kind of helping our teams navigate those. And in some cases, they won't turn out as we hope. But, it's important for us, we get it right far more than we get it wrong to deliver that outsized return. So what about, these multiples? Why have we kind of focused so much on that? But so when you look at this chart, and we've done a pretty significant piece of work with this over the past 6 months. So the data set is just under 300 globally listed fintech businesses. And we're extracting here only those in any 1 year that's growing north of 30% year on year. So we can kind of better kind of represent what the high growth businesses are doing from a multiple point of view versus ours. And you can see, even though our businesses on average grow, significantly more. So on average, as we've said over the last few months, 52%, but probably historically in this period, we're talking about 70 to 80%. So probably kind of a little 2 to 3x what we're seeing. We still are trading at that, or our multiples would be at a discount. Now, of course, you can dissect this and saying this is a cohort of 270 businesses, of which only 30 fit the growth mold, and you've got your 26 companies, and of here you've got your top 10. But I think that's really important that we're trying to use those as many kind of objective metrics as we can. And then when you apply the discount, you're then kind of really trading at around half. So sub 3 times forward revenue next 12 months for businesses growing on average north of 50%. So again, another demonstration of the measure to say that the market hasn't captured the strong underlying growth in the portfolio alongside the focus where it made sense to really kind of drive businesses to profitability. And in our case, as we just talked about, where we're not seeing businesses that we feel should be shifting to profitability at their stage, we're, taking that view that it makes sense to kind of write down the value because they're not kind of moving at the direction or as quickly as we would like. And we really need to work closely with them to help get them in the right direction. But I talked a little bit about this disconnect between the public and private markets. So this is really interesting, where we've taken out 4 of the kind of highest profile listed businesses, and we've, shined a light on 4 of businesses that we aren't an investor in the private markets. You will have heard of Revolut, of course, Klarna in Sweden, but a global business, Konto, which is equivalent of Tide in France, and Stripe, originally out of Ireland, but very large US payments platform. And you can see kind of the delta between the two, where, the likes of the public markets, the darlings in the fintech space growing next 12 months, up 20%, trading just a touch under 10 times forward revenue. You look at some of the best and high growth scale businesses in the private markets, 6.5 times. You look at the Augmentum growing quicker than all of them, 4.5, and when you apply the discount, we're talking 2.8. So there is, a significant, negative delta, and something that we really want to get the message out to say there has been a significant positive re-rating in the public markets that has not been reflected in our underlying portfolio from a valuation point of view and from a market rating point of view, still, because there is this skepticism generally in the VC and PE sector about valuations. But hopefully this just gives some real tangible data points of that disconnect in what we're seeing in the public markets and in the private markets as well. And what about exits? Well, we've touched a bit on that, but just to say that the direction of travel is, the early signs after 5-6 years is really positive. So delivering 100 million on, a 2018, 2019 vintage, it is a strong early start. Can you have conviction in those underlying valuations? Well, you've got to keep, proving this out over time. So of everything we've exited, on average, they've exited at a 33% premium to the previous reported valuation. And, that is important, that gives real kind of comfort that we're not valuing with hope for tomorrow. We're valuing on what we think these businesses can exit at today, despite the fact that we think there's significant upside to come as well. And that valuation methodology has kind of shifted in a market which hasn't been, I would regard, the most, robust for private companies. Should you be going out there raising capital if you don't need to? Not necessarily. And keep driving growth, keep demonstrating where it makes sense, that path to profitability. And as such, where you don't have the price of recent transactions, what auditors aren't doing is saying, well, you raised around 18 months, 2 years ago. That isn't fresh in the market. That isn't being perceived as a market standard. So they are looking at the public markets. They are looking at a basket of comparables. And that's really what's kind of driving that multiple across the portfolio of around on average kind of 4.5. But as I said, I think that, what that doesn't necessarily reflect is what we're seeing today in the markets, in particular of those kind of well-known fintech businesses that we saw growing, 15 to 20%, which are a significant premium to where we're at. But overall, I would say there are more kind of ups and downs. This is kind of a snapshot in time. So what are we seeing in terms of growth? And there's a lot of green arrows there. Of these top 10, 4 are now profitable, which is really important. And those that aren't, on average, is about 16 months of runway. So cash runway is important for us. We absolutely want to make sure that our businesses have enough trajectory in order to maintain growth, but also have a healthy amount of capital on the balance sheet in order to really kind of have their eyes looking forward, but one eye to ensure that if they do need to go and raise money, they've got a good window in order to be able to do that, hopefully putting their best feet forward, demonstrating both continued growth and continued improving economics as well. And this would represent around north of 70% of the NAV as well. So this is kind of pretty good representative of where the core of the portfolio is in terms of relative value to today. So as I bring this to a head, important to give you a sense of what we're seeing in the market. Where are we? Well, we're seeing a good number of deals being done. Thankfully, the average valuations have significantly come off from the heady days of kind of 21 and Q1 22, where we saw a pretty unhealthy amount of capital being fired in from all parts of the world and the markets that we don't normally see, whether it's sovereign wealth or hedge funds or family offices. It really did distort the market. That distortion will still continue to unwind but it has unwinded to a pretty significant extent. And I think we're kind of back to where we were kind of pre-2020, both in terms of value of deals, but also in relative valuations as well. And that later stage of the market has been impacted. Our core focus is coming in at that Series A, which remains kind of really, really competitive. And this is why, because the opportunity in fintech remains enormous. And I think it's something I talk about a lot, but I'm going to keep talking about it because the next 5 to 10 years, we're going to see hundreds of very valuable fintech businesses built across Europe, where we'd like to think that we're going to be well positioned to access a number of them as well. So we're in a market that, yes, has created hundreds of multi-billion-dollar businesses, but there's several hundred still to be built. Because this is a low single digits penetration, which makes it as a market one of the most underpenetrated when it comes to digital transformation. So that is kind of the top-down macro, huge opportunity. Sentiment ebbs and flows in the market, but the opportunity is really ahead of us. And I think for us as an investor, our job is to give you really well diversified exposure across the sector, to sift through the huge amount of noise, find that needle in a haystack, and hopefully find that, future Tide, future Zopa. And, as I said, I think the likes of an Artificial or a WeMatch or a, Intelis or LoopFX, these are all businesses that you might not have heard of, but they're in our portfolio that 2 to 3 years, hopefully we're talking about in the same types of glowing words that we have been talking about, those really big established ones that we've got on a really exciting journey with to date. And of course, the big incumbents, both the software players, I think, which is really important, alongside the financial institutions, their strategies fundamentally changed over the last 10 years. They recognize that the digital transformation from within is very, very hard to do. These are large, slow-moving organizations that recognize the importance of transforming, but recognizing it and executing on it are two very different things. So yes, they continue to invest heavily in their own digital transformation, but increasingly they're partnering either through investing alongside us, either through acquisition. As you can see, a number of those in blue are our businesses that have been bought by some of the biggest names, both in the software and financial services space. And they're working with companies such as XYB or KIP or Baobab in helping kind of build their platforms as well. And that's incredibly important. So we'll be playing both sides of the spectrum, working with the incumbents, helping solve some of their problem, but also backing businesses that are really stealing market share from them as well, as a result of their inability to be nimble, to adapt, and to operate at a lower cost that many of our businesses have that inherent ability to do so. And you'll just see this kind of M&A process and momentum continue. 24 has been better than the previous 2 years. I was actually surprised when I saw this number. Of course, average deal size is lower than the peak, and multiples are down. We don't have a data point to tell you exactly what they've been because these are companies, largely private companies. But fundamentally, we would expect that trend to continue as well over the next 5 to 10 years as well. And that's really important, because who are going to buy your businesses? These businesses are unlikely to go to IPO. 98% of all exits in fintech over the last 5 years have gone through M&A, not to IPO. And so when everyone talks about the IPO market, yes, we'd like a vibrant IPO market in Europe and in the US for fintech companies, but the vast majority of these businesses will not exit to IPO. And that is kind of a testament to the really strong strategic nature of this asset class, and alongside our portfolio as well. In terms of pipeline, what we have built now over the last 6 years is a really compelling proprietary platform, where we are taking in a number of third-party technologies. We're building that in our kind of affinity proprietary kind of CRM centralized workflow, because we need to generate edge. We are regarded as experts in the market. What does that mean in practice? Well, that means we are tracking north of 5,000 companies across Europe and beyond. that represents kind of 13,000 people in the market. We're seeing a lot of recycling, the flywheel effect of employees that have worked in great success stories in European fintech and spinning out and going off to do their own things. Employees from Revolut, from Zopa, from Tide, from Klarna. And they're really important ones to watch. And we saw that with the investment in Pemo, which were a team from that came out of Pleo, looked at where that corporate expense management hadn't really manifested in a big way, felt that MENA was an interesting area, set themselves up in UAE, launching in Saudi and Egypt. And, we felt that was an area where we had real visibility on the team. We could leverage our network, leverage our database. We've been tracking the team because we knew they'd left Pleo, gone into Pemo, and we felt we had a lack of exposure in that proposition in Europe, just because at the point in which that was being heavily funded, we felt valuations had gone well beyond, the realms of, let's call it kind of sensible numbers. And so even though we had conviction on the space, we didn't feel that there was a proposition in Europe at the time in which we were really, really leaning in, where we could kind of deliver that type of return. So it was kind of one of those areas where we felt, let's dip our toe with a team where we've been following, where we've had a lot of positive feedback on, and where the early momentum was strong. So, and that was similar with the Loop, which is building that closed-ended FX closed loop platform, which we've been tracking for a while. But the ability for us to get to a decision very quickly in a heavily competed process was, a testament to the platform that we've built, our domain expertise, and then our ability to kind of leverage our track record and our reputation in the market to get ahead of the competition and really kind of get that deal done. And then play a significant role, hopefully, in their kind of future growth as well. But fundamentally, we are in the business of saying no. And, we are saying no 99.78% of the time, depending on where you look at it. So there is a lot of noise. You need a really efficient platform alongside a team. It's a small investment team of 8. So, we see a lot of things and we have to have the ability to really identify quite quickly what are those propositions that really stand out. And over the period, we've seen an increase north of 20%. But, that's still only filtered through to 3 new investments. And, why don't we get deals over the line? Well, it can be valuation. It can be, when you really get under the hood, you find things that give you pause for thought. You want to see another 6-12 months of trading, or someone else comes in and moves to a conviction position quicker, and that's important. So do not underestimate what we have built over the last 6 years, which we continually need to kind of build on top. So we have that richness, we have that ability to really get under the hood very, very quickly. But also when we do have conviction, let's get to the right answer in a period of time that gives us that competitive edge. And that's something we're really conscious of as well. So I'm going to pause there. I probably spoke a little bit longer, but I really did want to kind of dig in a bit more on the kind of the valuation and the multiple piece as well. But I think, overall what we have is an opportunity today with a portfolio that's really showing strong signs of maturity, where there's a lot of growth ahead in the sector and within the portfolio. You can now really start to look objectively at the portfolio in terms of, how is it maturing? Are we seeing the early signs of a track record that gives us cause for real comfort? I think the numbers will demonstrate that that's happening. And also, is this a team that can give me some really differentiated access? How can I, as a retail investor, find exposure to these kind of high growth early stage businesses in a sector where I've got conviction? And the reality is, we are the only, listed early stage fintech fund in Europe, where we feel that we see the vast majority of opportunities. We have that really strong diversification. We have different stages now. Even though we focus from a new investment in early stage, we've got a number of businesses now becoming really established, and there is a path to exit. So you will see over the next 2 to 3 years, in my view, some of those kind of material exits coming through, and the ability for us to keep recycling, and hopefully the share price will catch up. It's long overdue, but we're working very hard in order to do that. So I'm going to open now to Q&A.
Perfect. That's great, Tim. Thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Tim, as you can see, we have received a number of questions throughout today's presentation. And if I may now hand back to you and kindly ask you to read out the questions, give responses where appropriate to do so, and I'll pick up from you at the end. Thank you.
Very good. Well, I'm going to kind of hit as many as I can. There's quite a few, so apologies if I don't get to all of them. First question, as it was the first one, and what impact are you expecting from Trump and Labour government? Well, yeah, I'm not a political commentator. I mean, I think net, what we're seeing certainly from a Labour government kind of is a positive continuation of their approach to fintech generally. So I think we have a very receptive government in that regard. I think what's equally interesting is a long overdue review of UK pension funds, their lack of support of UK venture, of UK listed, and I think the big challenge is how do we unlock that capital? UK pension funds have underperformed their international peers. They're hugely underweight relative to their international peers to the UK market. So I think there's a real opportunity there for capital to flow into the market, and hopefully, we will be one of the beneficiaries of that. I think the concern we have is how long that takes. I think Trump, who knows? I think clearly, if you've been following crypto, there's been a pretty big run up there in recent weeks, and commentators would argue that it bodes well from a regulatory point of view. I think net, I think it's positive for the sector, but let's see the execution versus the talk. So I think net, it's both government here and in the US. I think the argument would be it's net positive, but we will really want to see some of those words being turned into action in the short term. So if payment, I'm going to try and answer this. If payment was approved, would the managers use the performance fee to buy shares in the open market, given the discount to NAV? Well, we don't. I mean, it's kind of a notional performance fee in a sense, because you have to kind of get into carry. I'm a significant shareholder in Augmentum, and I mean we have as a fund and been buying shares. I think the opportunity really does present itself and is compelling, and I've many times been buying stock. So yes, I mean I think it's kind of a bit of a hypothetical question, but I think the nature of what we believe in and the amounts that we've already invested in the fund should be a testament in our conviction in what's ahead as well. I've talked about NAV, question on that. So that was kind of sent during the presentation. A question on the first slide had a valuation of circa 295, but in small print that falls to 275 for management fees. That seems quite high. I mean, I think it's important. It's not management fees. I mean, what that is kind of implied performance fees. So in effect, if you were to sell the whole portfolio today and kind of it hits the hurdle, so in order for management to receive any performance fee, you have to deliver an IRR of 10% across the basket of investments. And I think the way the NAV is calculated, it's after that kind of hypothetical performance fee as well. So it's kind of 164 is after that. But the reality is what you're not going to do is, sell the whole portfolio and, wind everything up and then, pay out a performance fee. So I understand that it's just the way that the accounting needs to be. But, fundamentally, the only way that the manager gets paid a performance fee is to deliver that IRR across that basket. So you have to deliver that return. And it's not just in marking up through valuations. That has to be in tangible realized capital coming back into the fund. And that's kind of really the nature of how venture capital is incentivized. We don't have huge fees. We're not the multi-billion-dollar private equity. Our fee kind of covers our cost base, but ultimately the reason that you can kind of hire very talented people who will stick with you for a long time is for the promise of kind of future realizations if you deliver. So the only way this team gets paid is if they deliver realizations. This is not about delivering higher valuations and no actual cash realizations as well. Question on, are you looking to sell off portfolio assets where possible? Since I'm just trying to read the question. I can't quite get that, but I think I get the sense of where that's coming. I think for us, we're always looking to, where possible, maximize returns to investors. I think what we don't want to do is sell off crown jewels. I think the rule of venture is hold on to your winners and lean in. And that's really, really important. And I think probably the best known and one of the oldest investors in venture in the US, and Sequoia, will tell you that. And that's one of the reasons they set up their own permanent capital vehicle, albeit private, not public. I think they can talk about the stats of the likes of Google when they sold into the IPO. Now, that's, of course, an extreme case. I think for us, where we're seeing businesses that aren't going to deliver that venture return, we absolutely want to look to deliver an exit there where we can, and then kind of look to recycle that money and go again. We had a really compelling example a couple of years ago, 2-3 years ago, where we had Interactive Investor in the portfolio, where there were opportunities to take money off the table at 500 million valuation, 700 million, at $1 billion. Every time in that journey, despite the fact that we had some investors saying, look, it'd be great to demonstrate an exit. At the time, I just really felt that as somebody who was sitting on the board of the business, seeing the direction of travel, there was a great opportunity of continued growth. So we bought in every opportunity rather than sold. And that one proved to be the right call because we saw a real direction of travel of continued growth, but also a path to exit, and the business sold for £1.5 billion. So I think for us, what's really important is, one, we're always looking, what do we think is in the best interest of shareholders? It shouldn't just be, well, we need to have an exit because we haven't had one for a period. It should be, do we think that this business has significant scope still to grow, and can we deliver a compelling return? And can we redeploy that money better other than leaving it in that company? And I think that's always kind of a difficult call to make. So we're always reviewing the portfolio. When the opportunity presents itself, we will look at it objectively without emotion. But fundamentally, we will look at it and say, now is not the time. There's a good reason for it. But, rest assured, whenever an opportunity does present itself, then we absolutely will look at it very objectively and seriously as well. So I've got a question on XYB, which is banking as a service that doesn't do its justice. The question is, it's a highly crowded market. I think the portfolio is excellent. Hopefully this will be represented in the share price. Regarding the infrastructure segment, how can the likes of XYB differentiate in the BATS market? It's crowded for one, and isn't there a strategic limitation issue for banks when they think about outsourcing their entire capability to a third party? It's a really good question. So why are we so excited? And, we've got a big position in that business. We own about 20% of it. There are a couple of tailwinds that we think are really compelling. The banking as a service market is fragmented, it's noisy. And so for us, it's what really stands this business out. I think, one, there is a piece of legislation in Europe called DORA. I do know what it stands for, but I'm not going to embarrass myself because I might actually get it wrong. But it is about the banks having a resilience, backup platforms, and that's going to be mirrored in the UK. I think XYB are incredibly well positioned. They've partnered with IBM to sell into the market, and they have a proposition that we think can be deployed quickly. I think as well, we would argue they are kind of platform as a service, banking as a service 2.0. And we see that in the proposition and the likes of Thought Machine have had real success in the market. But when we look at the side-by-side comparison, they can transact at 10x the capability, and they use about a tenth of that processing power. So, banks and neobanks, tier 1, tier 2, tier 3 have huge hosting costs. And I think when you see that reduction of 80 to 90% in hosting, that can have a saving of not just single-digit millions, but in the tens of millions as well. So we would look at what they built as a real next generation. And, I think they present a very compelling alternative to some of those perhaps BaaS 1.0 propositions that haven't built that scale in terms of processing, but also that efficiency as well. So that would be one to watch over the next 12 months. We've got high hopes. I think it's a classic example of huge potential, and we've got to give them, let's say, 12 to 18 months to really start delivering on that. Hopefully I can talk about that in a little bit more detail in the next update. Question, why does Tide need follow-on investment if it is profitable? Look, I think great question. I think the answer's somewhat simple. There's a lot of growth to come there, and what we're doing, with Tide, as I sit on the board of that business with our investors, it's fantastic growth in India, still very strong growth in the UK, big opportunity in Europe. And I think the question, as always, is how hard do you want to put your foot down? So if you've got a business generating 10 and you're investing 10, could you be investing 15 or 20? And so I think what that team is really focused on is maintaining really strong discipline on unit economics, and they're incredibly capable team. And so I would say that's just an opportunity to encourage them to go a little bit faster in markets where there is a significant market opportunity, and whether they're first, second or third mover, there's a big prize to go for. And if you're just focused one-dimensionally on maximizing profitability, you're going to miss some significant growth. So, they have been a team that's, to date delivered, every year. I think they'll carry on doing so. And I think there's a strong case to raise a bit more money to allow them to kind of lean into those markets where they're having real success. But it's not a kind of growth at all cost culture. So I think there's a strong rationale for doing so. A few questions on Grover, and I'm happy to talk about that. Please, please, could you tell us more about what went wrong at Grover, leading to the write-down, and how do you view Grover's prospects now? Look, I think as I touched on in the presentation, there's a lot of our businesses have gone through extraordinary growth journeys, growing from a few million of revenue to, low hundreds of millions. And they grow from 10, 20, 30 people to hundreds, and in some cases, north of 1,000. When we were building Betfair 24 years ago, we went from 40 to 1,400 in a pretty quick period. It was, we launched 75 international markets, which I was involved in. It was an extraordinary growth story. Growth masks inefficiencies, and eventually the chickens came home to roost, and there needed to be a huge efficiency drive when that growth slowed down. And I think you see that a lot in portfolio companies, and I think it's our job as investors, but also, and I think what stands us out is we've been on the other side. We've gone through these extraordinary growth journeys, but you do make mistakes along the way. And I think Grover's a good example of a business that just grew at an incredible rate, 25 times, its revenue over 4 or 5 years. But I think as raising fresh capital becomes that little bit harder, you need to kind of really look hard at the underlying, unit economics and say, is this the right structure? Do you have the right lending structure? Have you got the right product diversification? Are you in the right geographies? And I think you need to look a lot harder at the analytics of the business. And I think you have transitions where founders kind of cap out, and I think in that case, the founder stepped out, and we brought in somebody else. So I think they've got a very strong embedded position in the DAC market for kind of consumer electronics rental. So it's really an alternative to a Klarna, where they're integrated into one of the largest electronics distributors, so the Currys equivalent, MediaMarkt in Germany, so you can go to the till either online or in store. Do you want to Klarna it? Do you want to buy it, or do you want to Grover it and rent it? And I think, they've got a very strong market-leading proposition. They just have to improve unit economics, and I think they're going through those growing pains, and hopefully they can navigate their way through it. I don't see a new entrant coming in, frankly, in this environment. So as I said, I think their position is strong. They've got strong consumer buy-in. Their demographic is really strong, so it's kind of an AB demographic, and the brand is kind of well loved in the market. So I think it's just a classic example of get the house in order, and then once you're in that position, you go again. You put your foot down a little bit harder on the growth trajectory. So yeah, we'll see. We're on top of it. As I said, our CEO Richard Matthews is on the board, and working hard with management and with other board directors and investors to get it back on the path to where we want to see it. And hopefully, with hindsight, our approach will have been seen as conservative, but we've got to kind of do what we think is right. Hopefully, that kind of gives you a bit of a sense of that. We'll try and answer a couple more questions before we wrap up. What is your view on the new breed of early stage fintech VC managers? I think we, and they named a couple of them, a fund called Shapers, a fund called Reroute. I mean, we know both of them very well. We've co-invested with them in their previous guises when they worked in bigger funds. So I think for us, we need to kind of know the market. We co-invest. These would be kind of earlier stage managers in some respect. So, we would make sure that we have good visibility on their portfolio, on their pipeline, and we would see those types of funds on a pretty regular basis. I think in this market, the big challenge for a lot of emerging managers is, can they deliver, returns, DPI? And I think what we've seen in recent years, we've seen a lot of valuation markups. I think the challenge for a lot of venture funds has been, can they demonstrate consistent delivery of DPI, of realizations? And I think we're one of the few funds that have consistently done that, and hopefully will continue to do so as well. And that will really kind of hold our brand in good stead, and create real desire for that next generation of managers at the earlier stage in particular to want to invest with us and have us on their cap table as well. And I think that will be really important. So I'm just going to see if I can answer one more question. Is there a micro strategy within the portfolio? Secondly, could some of the 35 million of cash be used to dip your toe in those waters? It depends kind of what the micro strategy, and maybe that means a seed fund proposition. I think we'd really like to do seed. I think the feedback we've had kind of from the market has been seed doesn't necessarily fit particularly well in a listed permanent capital structure. The risk profile is too high. So what I would love to have is a kind of almost a separate GPLP fund where we could invest, and then the listed vehicle could really kind of look at following in to some of those kind of winners in there as well. So I think it's a really good question. I think it's a strategy where I think we could really enhance our competitive strength in the market, and it's something we're absolutely going to be looking towards, because we think it would be hugely additive and something which we have a huge amount of reach in that seed market as well, because we are building relationships at 1, 2, in some cases 3 years before we will invest. We're building relationships with incubators, accelerators, seed funds, pre-seed funds, founders. It's really important because we want to build that pipeline, and when an opportunity presents itself, it shouldn't be new to us. We should have seen it, we should have tracked it, we should have met the founder, we should have met the early investors, and we should be able to move quickly. And that's kind of the benefit of Ada, the CRM platform that we've built that allows it to do that and do that quickly. So yeah, I think something we will certainly be looking at, and something for a future conversation as well. And maybe we'll share some insights if we make some progress on that between now and the next reporting period. So I'm conscious I've run over by 4 minutes. So thank you for those of you that have stuck around. I'm sorry I haven't answered all the questions. There was a pretty significant number, but hopefully I've kind of answered, the ones that were, most consistent just in terms of people asking the same kind of thing. And, if there are any other questions that you feel you'd like to answer, you can always email me, tim@augmentum.vc, and myself or one of the team will come back if we can with a suitable answer. So thank you again for all your support. Thank you for listening, and look forward to touching base at the next period, which will be sometime the end of June, if not beginning of July.
That's great, Tim. Thank you for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Augmentum FinTech PLC, we'd like to thank you for attending today's presentation, and good morning to you all.